First, we would like to have the welcome remarks by Professor Yukihiro Ikeda, Dean of the Faculty of Economics at the Keio University.
Thank you very much. Honorable Council members, distinguished guests, my colleagues, and my fellow students, it is my great honor and pleasure to have two distinguished guests from the United States of America, Professor Robert Engle and Professor Peter Diamond. So as a welcome remark, let me introduce both of the great economists a little bit more in details. Let me begin with Robert Engle. He is a well-known figure in the field of statistical inference, and for his contribution, which is known as Arch method in this area, he was awarded the Nobel Prize in economics in 2003. After having teaching experience as young professors at MIT and UC San Diego, he was nominated as the Michael Armellino Professor in the Management of Financial Service at New York University in 2000. I think his contribution is technical, but at the same time, it has far-reaching implications for the world economy as a whole, and our economy, that is the Japanese economy in particular. In terms of systemic risk, he had various contributions in both of the economies. But let me stop here, since my performance of the statistics was very poor. I got C in my campus, at Hiyoshi campus, so I have to stop here. So let me go into the Professor Peter Diamond. He was the graduate of Yale University, where he had encountered Professor Kakutani, who is known as the mathematician who had discovered the fixed point theorem. And at the same time, and after that, one of his important mentors was Gerard Doprieux, a French-born economist who formalized the mathematical economics, as everybody in the classroom knows. And he was nominated as the first holder of Paul Anthony Samuelson Chair in 1992. And in 1997, he was nominated as an institute professor of the MIT. And as a historian of economic thought, I took a brief look at the biographical information of the two great economists. And I have noticed the following, which might be give us some insight to understand the standing point of the two great economists. Robert Engle's father was a PhD chemist at DuPont, and he was brought up in the tradition of natural sciences. So as he told us in his own biography, his father expected him to become a physicist, but later on he gave up his career as a physicist, and he has decided to devote himself to the economist. This is one story. And we have another story, this time from Peter Diamond. And as I told you already, his inclination toward mathematical method is very strong. But he said that the course of real mathematics is a little bit boring for him. So he has decided to give himself to the economic science. And both of the economists has totally different flavors, to be sure. But one thing is quite certain. Both of the economists are deeply embedded in the tradition of natural sciences. And as a historian of economic thought, I would like to say that this is one important phase in their own directions that economic science is deeply embedded in the tradition of the natural sciences. So having said this, I would like to invite first of all, Professor Robert Engle to give us a lecture. And later on, Professor Peter Diamond will follow. Thank you very much.
Thank you for the remarks, Professor Ikeda. So first we would like to start with the presentation, lecture by the Professor Engle. So please join me welcoming Professor Engle.
So it's a great pleasure to be here. I visited Keio University a few years ago, and it's nice to be back. Contrary to what perhaps I told you I was going to talk about, I'm going to talk about systemic risk because we now have basically 10 years since the great financial crisis, and we had a very distinguished conference in New York last fall, which included Ben Bernanke and Jean-Claude Trichet and Stan Fisher and a whole host of people who were, as they say, in the room when some of the major decisions of the financial crisis were made. And so we had a chance to have a little retrospective as to what we've learned about the financial crises and the probabilities that we will have another one. And as I say, that is also important because I think there's a sort of a political view that maybe we've solved this problem, we don't need to worry about it anymore. And I think it needs a little bit of examination. So here's what my talk is about, this volcano. This volcano is in Patagonia in Chile. And when you look at it, it's this beautiful mountain peak with a lot of snow on it. And I think of it like the financial system. But if you look really closely, you can see there's just a little wisp of smoke coming up. And the question is that enough to worry about? And how do we worry about it if we're going to worry about it? And one of the answers is we should be monitoring it. That's what we do with volcanoes. We monitor them. And so it's important to figure out how do we monitor the financial system to see when the risks are growing. And one of the things that immediately turns up is that you might see risks, but are they big enough that you have to worry about them? How do you answer that question? I'm going to shed some light on that today, at least try to. So I'm going to show you a variety of pictures that are on the website, VLab, which is the website of the Volatility Institute that I run at NYU. And if you go to, if you want to look at it, you can see it on your phone. You can Google VLab. And actually, we're not the top of the list anymore. For a while, we were the top of the list. But anyway, somewhere down the list, you'll find real-time financial volatility, correlation, and risk. That's what we're going to look at. So when you go there, the first thing you see is a map of the world. It's a color-coded map of the world. And what we have is volatility models, a lot like the ones that I got the Nobel Prize for, estimated for about 70 countries, on a variety of different assets in each country. And when the volatility of the stock markets of each of these countries is low relative to its historical values, the country is green. And when it's high, the country is red. So it gives you sort of an instant peek at what's the status today. And obviously what you see is that the map is pretty green. We are in a low volatility state globally, I would say, and this is as of March 15th, so this was a couple of days ago. You see a little bit of pink in China, a little bit in Venezuela, Argentina, but mostly it's all green. But if you looked actually last fall, you could see that it was mostly red. In fact, last fall we had relatively high volatility in many countries. Stock markets were collapsing. There was a lot of question of what's really going on. Is this the end of the bull market, or is it just a temporary period of volatility? And it's one of the things that is interesting to ask about volatilities. They go up and they go down, but what's going to happen next? And that's where it's interesting to ask about another financial crisis, whether that's likely to happen. So this is the opening slide opening picture of the VLab. If you dig into it a little bit further down, you'll see the sections that are in here. One is volatility, one's correlation, one is systemic risk analysis. That's mostly what we'll look at. Then there is a long-run value at risk. There is liquidity analysis, there is fixed income analysis, and then there's climate risk analysis. And I'm going to talk about the climate risk part of this on Saturday, I guess, when I do my keynote for the WEAI. So, among many economists, there's sort of a consensus that one way to talk about financial crises is in terms of excessive credit growth. When you talk about a financial cycle, a natural thing is to say, well, there is too much credit issued, and that actually brought on the crisis. I mean, you can see this in the books by Reinhardt and Rogoff. This time is different. There's a series of studies by the BIS. There are Adrian and Shin's story about leverage. But the problem is, how do you define and how do you measure when credit growth is excessive? Because we all know that credit will grow when the economy is growing. And what does it mean to say that it's actually excessive? So here's the way I would like to think about what makes credit growth excessive. Think about mortgages. When you're at the end of a credit cycle, what you would expect to see is that banks are making loans to individuals that are underqualified and on using collateral which is overvalued. So in that case, the value of this mortgage as an asset to the bank may be less than the bank thinks. And it may be less than the accounting value of this mortgage. So when the market value of the mortgage is less than the accounting value, this is the beginning of how we might define excessive credit growth. But it's also important to notice that if there is now a downturn in the economy, then the borrowers will become even more underqualified and the collateral will also become more overvalued relative to what its actual value is. So the bank will then be forced to use some of its reserves to cover this decline in the market value. In other words, the stock price will fall as the market value of this mortgage declines. And this is the capital cushion of the bank, and if the capital cushion is not sufficient, the bank will fail or will need bailout from the government. So the question of whether this is excessive credit growth has to do with not only whether the market value is far below the accounting value, but also whether the bank has sufficient reserves to cover that. You know, when we are individuals, we have some savings that if we lose our job, we use our savings to provide income until we can find another job. So do we have enough savings for that? That's the question we're asking about the banks. So how do we measure this? Well, we're going to use a measure called S-risk, which is the answer to this question. How much capital would a financial institution need to raise in order to function normally if we have another financial crisis? So that's what we're trying to measure. It's going to be in dollars, and it's associated with all the assets of a financial institution. So what we mean by a capital shortfall is that some fraction of the assets of the firm, which we're going to define as the debt plus the equity, should be less than the equity of the firm. If it's bigger than the equity of the firm, then there's a capital shortfall. And the little k here is what we use as a capital buffer, and we're going to use 8% as a capital buffer. So we think that 8% of the assets should be less than the equity of the firm. But we want to know what that number would look like if there is a market downturn. And so we need to ask the counterfactual question: what would the equity value of the firm be if there is a downturn? And what that means is that the assets of the firm go down in value. We're going to use a common technique in finance, which is the beta regression, which says that the rate of change of equity of a particular company is its beta times the rate of change of a global market index. And we are indeed going to use a global market index here. And the beta tells us how sensitive this particular company's assets are to a decline in the global stock market. From this equation, we can calculate what the equity would be under a stress, which is a decline in the world equity market, and we can calculate the capital shortfall conditional on this decline. And that is our measure of S-risk. The interesting econometrics here are associated with whether the beta is actually constant or not. I showed you volatilities that are changing in all these countries. Well, if the volatility is changing, is the beta likely to be constant? The answer is probably not, because the beta it's a regression coefficient, and so it's made up of a correlation and two volatilities. So if these volatilities are changing, there's a good chance that the correlation will be changing and that the beta will be changing. In fact, we use a beta that is allowed to change every day. This is the well-known formula for a beta. It's the correlation times the ratio of two volatilities. And we are going to use the estimates of each of these volatilities from a type of Garch model, and we're going to use an estimate of the correlations from the dynamic conditional correlation model, put it together to get a time-varying beta, and this is what it looks like. So here's the time-varying beta for Citigroup. And what you see is that on average, it's more or less equal to 1. That's what an average beta should be, although it has some peaks in it. It has a peak around 2009, which is quite high, which suggests that when the global stock market goes down by 1%, Citigroup's stock price would have gone down by about 4% during the financial crisis. Why should it be so much higher during the financial crisis? Well, the answer is, one interpretation is, of course, because the volatility of Citi has changed. But why does the volatility of Citi change? Well, the answer is Citi was heavily invested in mortgage-backed security business. Chuck Prince was saying, you can't stop dancing till the music finishes. And the global market was very worried about the viability of this mortgage business. And as the global market started to decline, Citi was in the sights of all investors, and its stock declined much faster than the global market did directly. You see a second peak in 2012 a little bit when the sovereign debt crisis hit Europe. You see a third peak in 2016. But this is not the way all stocks look. Goldman Sachs, for example, is higher. It's about 1.4 on average, which means Goldman Sachs was a riskier bank according to the stock market, but didn't have such a peak in 2009 because it didn't get into that business. And insofar as it had mortgage-backed securities, it actually bought insurance from AIG and got AIG into trouble. If you look at BNP Paribas, you see no effect really in 2008 and 9, but a much bigger effect during the European sovereign debt crisis, which particularly affected BNP Paribas because they had a lot of investments in peripheral sovereign debt, particularly Greece, at that period. You also can see in 2016 a peak around Brexit. So Brexit is not just have an impact on British banks, but it also the continental banks. Here's Barclays. You see the Brexit peak is even more striking. They also suffered to some extent during the financial crisis and during the sovereign debt crisis. And here's Mitsubishi UFJ. So you see they have a big peak, but this is not at the financial crisis. This was in 2003 when the beta rose up to 3%, up to 3, and then dropped back down and basically has been relatively insensitive to these events that we've been talking about. So this is the data that we're going to use, this plus accounting data, and we're going to be able to calculate the S-risk for banks all over the world. So when we do that, where is the risk? And well, you can see from this picture that there's a lot of risk. In fact, I don't know whether you can see the pink visor. Can you see a pink visor in this picture? There? So that's my wife. and this is me. And this is the risk manager. And he has about a second and a half before he loses all his credibility. Okay, so what do we see? Well, if you look at the global sum of all the S-risk for the entire world, we see what it would take to bail out all the financial institutions in the world if we have another crisis like the financial crisis. That is a 40% decline in global stock markets over the next 6 months. That's the stress. And what you see is there is a big peak at 2008, 2009. It adds up to something like $4 trillion. It's a big number, not outrageous. And then things get better, and then they get bad again. So there's a second peak here, which is the sovereign debt crisis in Europe. The first one is associated with mortgage-backed securities, and particularly U.S. initiated. The second one is associated with sovereign debt, European sovereign debt. Again, it's viewed as a riskless asset by regulators and investors, but it wasn't riskless, just like the mortgages were not riskless. Well, here is a third peak, which doesn't have a name. I think we're going to call it the Chinese or maybe the Asian debt crisis, because this was a period when China started to slow down. They stopped buying raw materials from all over the world, and banks in resource-rich countries were in trouble, and their capital margins vanished, and their S-risk rose dramatically. So if that's what this one is, what's the last one? If you look at the last one, it's almost as high as the other three, and that's where we are today. So one answer is it's the result of this volatility that we had last fall, and what was the cause for that? Well, I think a lot of people think the cause for that was the trade war, or the tariff war that we had between the U.S. and many of its allies. But it also, I think it has to do with a slowdown in China, again, which really has not ended since 2016. The economy is still not growing as fast as it used to, and I think the pain is a little bit greater in China than it was before. So we want to keep an eye on what this last peak looks like, because this is the concern if we're thinking we might have another financial crisis. Where is this S-risk? Well, the largest component is China, but the second largest component is Japan. So we have to talk about Japan. And then we have France, United States, UK, Italy, Spain, Korea, Germany, and so forth, on down the list. So when you look at the US since 2000, you see a big reduction in S-risk, all the way to more or less January of 2018, when I think it would be easy to say we've solved this problem. Unfortunately, the data doesn't stop in January of 2018. It continues for another few months that we've now seen. And as you can see, it started to rise again in the US, and that makes it a little more credible that this is actually part of this trade war that we're talking about, where the US is hurting itself by trying to impose tariffs on its trading partners. But if you look at China, you see a much more unattractive picture. The very rapid increase since 2010, there was no systemic risk noticeably before that, and it increased. It actually peaked in January of 2019, and it's come down a little bit since then. It may be that the trade war is hurting the U.S. more than it is China. I'm not sure. And what about Japan? Cherry blossoms are about to come out. It can't be all that bad, right? So here's the picture for Japan since 2000. And what you see is it's been increasing pretty much all along, although it recovered quite a bit since the 2012 sovereign debt crisis, but now it's increased fairly substantially toward the end. And to some extent, this may be Abe economics, which has increased the debt and maybe hasn't stimulated the economy as much as people would have hoped, but maybe it's also the tariff war. There are a lot of things to talk about there. We could really discuss some of this during the Q&A. The Japanese banks show that the largest single S-risk figure is for Mitsubishi. And I think actually the big numbers in this table are really because the Japanese banking system holds a large fraction of the sovereign debt. The Japanese government bonds are very important assets for these banks. They're typically viewed as riskless by the regulators and perhaps by the banking risk managers as well. But that has been the source of financial disruption in previous financial crises where previously riskless assets become risky. And so that's kind of this question of how much debt can a sovereign really amass without there being a problem? And to be fair, Japan has had slow growth, but no financial crisis, it seems to me, over the last 3 decades. We wouldn't call it a financial crisis probably, although it may be a financial crisis in another form, which would be of the nature that the banks, because the assets are so heavily oriented toward sovereign debt, they may not be making sufficient loans to the small and medium-sized enterprises that need to grow. So there's a sort of a crowding out kind of a argument you might make about why growth is not coming as fast as it could in Japan that's associated with these numbers. Okay, I could show you what these things look like before the financial crisis, but I'm going to skip over this. Turns out that Lehman is not at the top of the list. It's number 10 or number 11 on the list, and the top 10 were rescued. So Lehman almost was bailed out, according to this table, but not quite. And according to this table, the regulators made the right decision. They bailed out the more important banks and let Lehman fail. That's just, okay, let me just skip on. So I told you I was going to ask how much risk is too much. Clearly this is too much, right? Yeah. Okay, so how much risk is too much? So what we want to know is what's the probability that the amount of risk we see would result in a crisis, and what is the amount of S risk that an economy can survive without getting the probability of a crisis bigger than 50%? That's what I want to calculate now. The probability that we're in a crisis and the capacity of a country to survive without being in a crisis. Okay, so basically we've got big countries and small countries. We need to normalize by something. It turns out that the best thing to normalize is the total assets of the financial system as a whole. The reason that's the best thing to normalize by is when banks try to deleverage, they start selling assets typically. If the amount of assets they have to sell is a big number compared to the total assets in the financial system, they're not going to find buyers. The price is going to go down. As the price goes down, the banks become even weaker. They have to sell even more. They become even weaker. We call this the fire sale spiral or the fire sale externality. And dividing by total assets captures that. We're going to use a crisis indicator developed by the Romers to see whether a country is actually in a crisis. And we're going to run a panel regression where the dependent variable is how bad a crisis are we in now, and the right-hand side is what's our S risk divided by total assets. And then a few other things, okay? this regression you could do with ordinary least squares, but in fact, that's not the best way to estimate it, because we have lots of periods where there's no crisis, and then the S risk is 0, and the crisis is 0. So we really should have a hockey stick shape rather than a straight line. So we're going to use a Tobit model, which does that. I'm going to show you the results from, well, just actually, there are two models here. One is just domestic, which says it's your own S risk that matters and the rate of increase of that. The other one says it's your own S risk that matters, but it also matters what the global S risk is. That is, the rest of the countries make a difference as to how fragile you are. And that is, I think, an important feature. So there are two externalities in this model. This very, very simple little model has two forms of externality. One is we add up S risk of all the firms in the country, and so the risk that any one firm imposes on this country to have a financial crisis does not just depend only on that firm, it depends on all the rest of the firms in the country as well. So there's an externality within the country, and there's also an externality between this country and the rest of the world. So if you're super strong and the rest of the world is weak, you might still have a financial crisis. So we can now superimpose on the S risk data, which is the orange curve on the top graph. This is the S risk that I already showed you for the US, and the back line is the capacity. So when the capacity is above S risk, you say a crisis isn't too likely, and we have a probability down here which is really quite low. When the S risk gets high relative to the capacity, which in fact dives down here because it's the rest of the world's S risk, and in the middle of the financial crisis, many countries' financial systems were weak. So the probability of a crisis went up to basically 100% in the US here in 2009. It went up a little bit less during the European sovereign debt crisis. Here's the China crisis, and now I guess this isn't quite updated. I don't know whether this goes up noticeably or not at the end here. It might. Okay, so that's the US. Do you want to see the next picture or not? Okay, this is the last one. This is Japan. So here is the S risk picture for Japan that we looked at before, okay? And now we have on this picture as well the capacity. And what you see is that the capacity has been increasing very substantially over the period of this sample period. And so even though S risk has increased a lot, the capacity has also increased a lot, so that the probability of a financial crisis in Japan seems not to have gone to 1 at all, given the big rise. But it's higher, and the probability is now, we think, up to something like 40%. So maybe it's a problem, maybe it's not. We can talk about it. But I think it's pretty clear that the financial system deserves research and attention, because it's very much of an outlier in a lot of the world's financial behavior. And so this is the end. So these are two of my grandsons wondering whether they're going to have a financial crisis in their future. Thank you.
Thank you very much.
Let me not forget my notes. They're here somewhere. Sometimes I think I should only have one pocket, but then I look at my wife's purse, and it's even harder to find things. So, Good Pension Design is the title of a book I'm working on together with Professor Nicholas Barr of the London School of Economics. And the idea is to draw on two things. One is economic theory about what pensions are supposed to do and how we judge whether they're doing it, and secondly, to look at a number of examples. Japan is not one of the examples we've looked at because it's complicated and we prefer simple. And also, we're looking at the countries which there's a general consensus in the research community that they're doing something interesting. And doesn't mean they've got everything right, but a place you might learn from. So let's start with pension plans. There are lots of different kinds of pension plans. The traditional ones, the things that were the earliest kinds, are a defined contribution plan where you put money in, it buys assets, and when you hit the stage of retirement, the accumulated assets are used to finance your retirement, perhaps by you're taking things out month by month, perhaps by buying an annuity from an insurance company, variety of mixes of how you do that. A defined benefit pension plan is one where as you make your contributions over time, each contribution is part of a formula that will tell you how much you're going to get each month after you retire. And the benefit then is something that's paid while you're alive and stops at the end, so it's a form of annuity, although there are wrinkles. You can arrange to protect a spouse, you can arrange to give it otherwise. Starting with the mid-90s, in part in reflection to the problems of aging all around the globe, countries, first of all, felt they needed to make changes, and secondly, they were looking for new forms which would make the future need of severe changes less likely. Politically, when a pension system runs into trouble, you've got two options: put in more money or lower benefits. Either thing you try to do is going to make someone unhappy, and politicians, or most politicians, don't like making people unhappy. It's not true of all of them. I don't want to talk about these other animals. I want to stay with just the defined contribution plans, because that's something that I thought would have elements in it that would interest undergrads who were thinking both about saving generally and investing, and who are no doubt not thinking about retirement. So I've picked that to focus on. And what's been happening around the world, a prime example is the US, is a huge swing from defined benefit pensions to defined contribution pensions. It's happening in Japan as well. And the idea here is, with a defined contribution pension, the risk is heavily on the worker during the time of accumulation, and unless an annuity is purchased from an outside insurance company, the risk afterwards is going to be mostly on the worker. With a defined benefit plan, the risk is on the sponsor, which is a term to say who has the risk. So national systems, the sponsor is the government, and the government has to figure out what to do if the thing's running out of money. If you have a corporate plan, then it could be on an individual corporation or a set of corporations in an industry. And then individuals can set up their own pension, but that has to be defined contribution. And of course, that's what Japan is now encouraging, as are many other countries. So I want to talk about two things. First, let's look at how different countries handle the accumulation process, and can we find ways to do better than at least some of them have done, in part by looking at what others have done. And then secondly, I want to look at the annuitization process, which is a much more difficult problem, and toss out a few interesting things that are happening. Let me start with an important lesson for young people, which is the importance of compound interest. So the idea is if you put money away at 30 for retirement benefits when you're 70, and the interest keeps earning more interest, that's compound interest. And as you can see from the chart, that gives you a lot more money if you start early, assuming the interest rate is positive. And therefore, the importance of getting young people involved in thinking about pensions, but also the importance of understanding how the financial market works, how you can get better returns, because those better returns matter for how much you end up with. There are two big problems with pension systems that want to just encourage people to save, give them some tax breaks, and let them loose. One problem is on the form of what workers, particularly workers who might be mandated to do this, as in many countries, understand about the workings of the financial market. So there's a sizable literature doing surveys trying to understand the extent to which the public in different countries understands the finances of asset markets. And so here's a rather simple question that has been asked repeatedly in surveys in different forms, not always $200. And here's what happened in this particular example where it was a survey in the US. What are people getting wrong? Well, mostly it's forgetting the compounding. So the fact that you get interest on interest in that second year. So if we're relying on people making decisions, we're mandating, so we've gotten away from the procrastination problem. We still have a problem, do they know what they're doing? The extreme version of this came out by the head of a regulatory agency in the US when the Bush administration was proposing to replace the defined benefit national Social Security system in the US by a defined contribution plan. He said the trouble is, from a survey he'd seen, half of the Americans don't know the difference between a bond and a stock. That would make it tricky to figure out what mix of the two you might want. So that's one problem. The other problem is how the suppliers of financial assets behave. And there are two kinds of problems out there. One is, do you understand the financial assets you're buying, how it works? And are the suppliers trying to help you to understand or trying not so hard to help you to understand? And the second question is, if you have an idea of what you want, and you may even have a sense of the different risks and the importance of diversification, do you do a good job of shopping to pick a good supplier? That is tricky, and that's where search theory comes in. The appeal of this study is they're looking at a whole bunch of assets that are essentially identical. They're index funds based on the S&P 500, and by and large, different firms hit the index pretty well. There may be some tax issues involved, but again, not if it's in a pension plan, because the taxes are just collected at the end. So the light bars are the range of fees being charged by different institutions who are selling them. And it's all over the place. Some people are paying a lot for what is essentially the same asset they could get for less. And the dark bars, which still have a spread but are clustered much lower, are what institutions pay when they are buying assets on behalf of, say, the people in their pension plan. And two issues here. One is there's still a spread, so maybe the people running them aren't as financially wise as one might hope for. And secondly, they're a lot lower. Now, what kind of difference does it make if we're talking about fees that are being charged by the financial firm for its activities? Well, one type of fee is what's called a front load. You want to buy something, you pay a fraction of what you buy up front before you buy it. And how much do you lose when you come to retire and cash that in? Well, you lose that same percentage. If they took away 1% when you bought in, you've lost 1% at the end. It's not there. What happens if they charge you each year a percentage of the assets they're managing on the grounds that they're sending you statements each year, they're giving you information each year, they're answering questions, and they're managing the purchase and the sale? Well, that relationship is ballpark a 20-to-1 relationship. And why is that? Because if you have, as this calculation was based, a 40-year career, you can think of the typical dollar you're putting in there being hit with a fee 20 times. Some of them are hit 40 times, some of them are hit once. And so if you have 1% of your assets for a fee each year, you've lost almost 20% of what you would have had if that charge wasn't there. So the issue here is understanding the importance of that spread I showed you. If those spreads, those were annual fee charges, are large, the impact on what you'll have is large. That's one aspect. What about the other aspect? Well, this was a study that really shocked me. These people did text analysis of the formulas that a financial provider was using to determine how much you got. And there'd be a headline rate. This is the number we expect you'll be able to get. And then there are a lot of details of circumstances in which you'll get less. And so what they found when they did the study is the higher the rate being quoted, the more complicated the rest of the story. Is this a way to educate people about how to invest, or is this a way to respond to the fact that there are a lot of people out there that don't understand, don't read the fine print? The U.S. created the Consumer Financial Protection Bureau to help people deal with a variety of things, credit cards as well as investment opportunities. And I was talking to some people at the Fed, because the Fed had the job of regulating the reports. And the way it was explained to me is this used to be done by lawyers. A lawyer would read the statement that the bank provides to a customer and ask the question, is it accurate? End of the question. What the Consumer Financial Protection Bureau does is rely on behavioral economics and ask the question, is this something the typical person is going to understand? That's a much tougher test. And the second thing is, if you're trying to compare across different investments, do you get information that's comparable so it's easy to figure out which one's better, or do you get interests that are very hard to follow? So now let me turn to pensions after that background on financial markets, and I'm not going to touch on S risk or any other kind of risk. If you look across countries, there are 3 different styles of organizing the accumulation phase of defined contribution pensions. Some countries mandate or strongly encourage, as Japan is doing, individuals to deal with financial providers. The 2 I'll tell you a little bit about are Australia and Hong Kong. Some of them follow Chile and have a small number of highly regulated firms that compete for this mandatory market. And some of them are focused on having a single central organizer. The example in Sweden has been running since the mid-90s. Nest in the UK is something that's been recently set up and looks very promising. And the Thrift Savings Plan in the US is a defined contribution system for federal employees. Now, there are over 3 million people in the plan, so it is up there with certain countries. But it also gives a somewhat misleading overall picture in that it's dealing with one employer. Everything is electronic. The information about the investment you can get from your employer instead of from the pension plan manager. So the costs are lower than they would be, but it still is an interesting example. So let me start with Australia. What makes Australia interesting to look at for a world with so many pension plans and so little time for people writing books is that they just had a commission review the entire system. And so this has been in place for a number of years. It's mandated. It's run through the employers. But individuals can also do their own choosing. And what they found, this is extract from their report, there are lots of funds that consistently give high net returns, which is an important part of getting a good pension, but a significant number of products underperform markedly. And there are numbers how many thousands less a typical worker will have if he's drawn the wrong thing. A major part of that is fees. A major part of the problem around the fees is limited ability to get comparable information to tell what's doing better and what isn't, and the government not doing a good job of regulating the thing. So that's coming out of an Australian government review, and needless to say, they're having a major fight over what to do about it, because the financial industry, which is the source of a lot of the worst funds, has a lot of political clout, and a lot of the best funds are run by the unions on behalf of their workers, and they don't want things changed for a totally different reason. So let me turn to Hong Kong for 2 reasons. One is Hong Kong has also been studying its system with unhappiness, and Hong Kong does a really good job on the internet of forcing the different firms to report in comparable ways. But even so, it's not enough. And when a anti-regulatory government, as much as Hong Kong is, says it's not enough merely to rely on market forces to drive down fees, this is telling you this is a pervasive problem, which it is. So let me show you a few Hong Kong numbers. So what they report, you can see it for every single opportunity that's out there, is the expense ratio. That's how much is being charged, either as direct expenses, which you can see, or underlying costs in the funds which come out of the return. And so here's a range of numbers. Obviously, the fees are different for things that take different degrees of research and care and knowledge. But so the interesting thing is to look at a single type. Even within types, they're going to be different. That's why I brought out the S&P 500 index, because those were all the same. So the difference between the lowest and the highest in annual fees is enormous. And you multiply that by 20, and you see the huge difference it can make in what you have at retirement, depending on how it's going. The other thing that happens when you turn people loose is people end up with multiple accounts. Here's the Australian picture. Why is this a problem? Well, a lot of the cost of running a pension system is a cost per account. You're communicating, you're answering questions, and the Australian report that I just cited says we've got to do something to make sure people mostly end up in one account, combining the different things. There's diversity in portfolios within an account. So this is part of the cost problem that's there, and it's a significant one when you're turning people loose in the market. So next I want to tell you the story of Chile. In 1981, under the Pinochet military dictatorship, Chile scrapped the pension system it had, which by all accounts was not a well-run, well-designed system, and put in place a mandatory defined contribution system to be run by private firms, highly regulated. Unions were not allowed to run them. Existing banks couldn't do it inside the bank. It had to be a separate institution, and it was meant to be free entry. And they thought competition would just make this work very well. What happened is it didn't work very well. The fees were very high, and the Chilean government, both then and after democracy came, repeatedly revised the rules year after year, and successfully. Steadily, the fees have come down. The fees are still high, as measured by looking at the profitability of the large companies that are there, and they're getting supernormal profits. On the other hand, if you compare the fees with the fees of just going into the stock market or the financial market outside the system on your own, the fees inside are lower. And why is that? Because they're differently regulated and small number of firms dealing with a lot of people under government supervision. So Chile has worked at this long and hard and made it work. The Chilean example was wildly applauded by the World Bank, and most of Latin America has imitated it, and no other country in Latin America has managed to have fees as low as Chile. It's a hard job, and many of them have not been up to it. The idea spread elsewhere. There's one of them in some of the previously communist countries, several of them. And then people were discovering that they didn't work as well as the Chileans had suggested at the beginning, as the World Bank embraced. Even China was going to start it, as if you could turn the general public loose on the stock market in China. Rather crazy idea, both for what was understood and for the kind of institutional structure that you'd have to build from scratch. So then there was a big move away from it. Never got implemented in China. A number of countries that did start it then shrunk it. Argentina stole all the money from it to help deal with the other pension plan. Chile has it. It works pretty well. They're still working away at it. And the most recent innovation, I think, is just an interesting thing to come up. Every 2 years, they have a bid, an auction. One of the firms called AFPs, for the Spanish name for that I won't try to pronounce, for the pension plans. And the one that comes in with the lowest bid will get all of the new entrants into the labor market for the next 18 months. But they've got to use the same bid for the existing people. After 18 months, they can raise their fees. And the expectation is, since a lot of people are sluggish, they won't move away from it, and you'll have long-term clients. This brought in, first of all, big advantage for new firms. So this saw the growth of some very small firms, and in response, some of the big firms lowered their fees. So it was a small success. Next time around, it didn't do it very well. But it's the idea of being creative, recognizing this is an ongoing problem. Next, I want to turn to having a single central organizer. And the 3 examples I already mentioned, I'm going to go to. And I want to focus particularly on Sweden. It's been running since the 90s. What happens in Sweden? The government collects the contributions along with other taxes. And the government does all the record keeping for each individual. So the individual banks and other financial institutions that run mutual funds don't know who their customers are, although in sneaky ways they can find out. Like you go to get a mortgage and they ask you, are you invested with us? And that might affect your mortgage. The government has a fund that competes with the private funds. So what does it look like? They had so much faith in the market, they said any firm operating anywhere can come in here. So there are 843 private funds from 108 management companies. They recently had a scandal. One of them was a scam from beginning to end. And so they're now saying, oh, we've got to police it. And you can see lots of different kinds of funds. So the government charges all of the mutual funds for the fact that it's doing the administration. It's keeping the records. It tells each firm the net amount of transactions of people going in and going out. And that's all it's doing. The government's cost is charged to all of them. The government isn't paying any of it. Secondly, the government says to a mutual fund, you want to come onto this platform, we're doing your record keeping. So you've got to charge us less than you're charging on the same fund in the general market. How much less? On average over the firms, almost 50 basis points, almost half of 1%. The capital management fee over everything is 0.23, way below those numbers I showed you for Hong Kong, way below the numbers on average in Australia. And there are also transaction costs within it, so you add those in, it's 28. How well does the government do? The government is much cheaper than any of the rest. The government also built what's the equivalent of a sovereign wealth fund. It's invested all around the world, and it's doing better than the rest of the portfolio is on a consistent basis. So in any of these systems, given what I said at the beginning of financial understanding, there are lots of people who won't choose. So you've got to have a default. If you don't answer the question, what do we do with your money? Because we're collecting the taxes. So the government firm is the default. And as you see, almost half the savers are there. Some of them, because their young people came in, didn't do anything, and may not have paid any attention to it. Some of them because they recognized this was the best deal going. And to begin with, you couldn't choose to be there. The only way you could get there was by not mailing in the form. So I was in Sweden when this was coming out, and I spoke to some Swedish economists who said the first thing they did when the instructions came was tear up the form because they knew which was going to be the best deal around. And so the issue of designing a default is important, and the issue of having the government run something well is important. That approach is what Nick Barr and I recommended for Australia, and they're horrified. They're not willing to consider it. They've got something wild. If I had another half hour, I'd tell you about as a proposal, but the proposal isn't going anywhere. So let me just tell you about NEST, which is a couple of years old in the UK. UK has a mandate that every employer above a certain size has to have a pension plan for the workers. And workers can opt out. They don't have to do it. But because small firms would have big fixed expenses in setting up pension plans, employers can just hand the problem over to NEST, this government agency. And the government agency designs the options for the workers to choose when they come to NEST. And they have a small number of firms. They're doing all the account administration. They're taking the money to the mutual funds that they use after bidding to see which ones they'll use, and so they get low fees. And the savings are fully portable. You have one account, you have two jobs, they can both go into the same fund. So it's completely online for employers. There are no charges, just compliance costs. And they think they can run it on a permanent basis at 30 basis points, about the same as the Swedish example. And there's a temporary charge to cover the setup costs, which they finance by borrowing from the government. The Thrift Savings Plan has 5 funds plus life cycle funds, and workers can choose any mix of them they want or not choose and have it picked for them. And the fees the funds charge are minuscule. 1 basis points, 2 basis points, 3 at the outside. So that's an enormous way of saving money. What about benefit structures? Well, there's a wild array of different things that can be done, and I just want to tell you 2 things. First, matching the issue around the difficulty of picking an investment. Annuities are complicated. People have even more trouble. And there was a time, it's been repealed, when in order to get the tax advantage in your individual pension plan, savings plan, you had to, at some point, use 75% of it to buy an annuity. And the Financial Conduct Authority explored how people chose annuities. Well, their funds had been managed by a firm. That firm either supplied or connected you to a firm that supplied an annuity. 60% of people weren't going shopping in the market. And how well did they did? Well, 80% of them could have done better in the market. So the idea here that the annuity problem is even more severe than the accumulation problem is a clear message. What did they do in Sweden? It's not a large account because they also have a pay-as-you-go part that's separate. So you hit retirement, mandatory annuitization, and you can choose to do something which is a government-run firm that's supposed to imitate the way the private market works. So the rules are vague and a little bit unclear. Or you can keep your money invested any way you want, and the government has rules based on life expectancy of how much you get each year based on how much you have. And how does it work as an annuity? Well, what happens is when people die, their capital is distributed to the other people who are in the same birth year they are. So the sharing of the risk is internal to the people in a single birth year. And that, for those of you who are historians, is a form of tontine. Tontines, which lots of people have never heard of, were named after Lorenzo di Tonti, who designed it but didn't actually get one launched. And in the 18th century, when countries were having trouble borrowing for their wars, the idea of selling bonds as a tontine turned into a way of raising lots of money. So how does that work? The government sells a 20-year bond to a whole bunch of people, and each year they pay the interest on it. So it's not like the Swedish design to try to get you in a nice shape. Each year they give you, let's say it's a 10% bond, 10% of what you bought, except when people die, they no longer get it. So the government is paying out at 10% of the total, and the longer you live, the more you get. In the movie version of it, the last guy gets everything, and so you can have people trying to kill each other off. In the actual version, they had finite ends, and so that wasn't really happening. I think the idea of saying, can we do better than relying on standard regulated insurance companies selling annuities seems to me to be right. Is this going to prove to be better? We need studies of it. They don't exist yet. But again, creative ideas are happening. And if you'd like to read more about what I've talked about, and you don't want to wait for the new book to appear, the last book Nick Barr and I wrote is available in a whole bunch of languages, but not Japanese. Thank you.
Okay, thank you very much, both, for very insightful and thought-provoking presentations, especially for Japan. So we would like to go on to the question and answer session. So could you wait a moment? We're gonna set up the stuffs for to be ready for the question and answer session. So if you would like to ask the question, please tell your name and affiliation.
I'm a faculty here at Takemori. About S risk, when I'm aged, I get slow and catching at the mathematical formula. And if I remember correctly, S risk may go up. Okay, the idea is that the asset that bank holds may go down in value. Right. And whether it can be covered by the equity that bank issued. So the S risk may go up when the equity of the company goes down. And you measure that with a beta measure, right? And so when you show us the S risk of Japanese banks, so it may be that beta for these banks have gone up, or the probability of asset value going down is increased. If you know which is more important, I cannot see an exact reason why Japanese banks beta may go up. I'm not particularly knowledgeable whether Japanese banks' equity is so volatile compared to the worldwide equity markets. So probably it's probability of assets going down. And I was just curious. And I also want to know whether we can pick up beta alone to find risky institution, or is it not a correct indicator to find a risky institution?
Can I
Okay. I showed you the beta for Mitsubishi, and that was not particularly high. So the increase in beta, I don't think, is the explanation for it. I think what the explanation is there are two things. I think the leverage is high for the bank. So if you look at basically just simply the market value of the bank divided by, say, its total liabilities or something like that, I think the market value is getting small relative to the total liabilities.
Japanese bank has gone down.
That's right. And so when regulators say that government bonds have a risk weight of 0, then all of a sudden the denominator is much smaller. And that's actually the way regulation typically goes. They use risk weights. We instead use the beta as a way of measuring risk. But the beta isn't particularly high, but it also isn't 0 either. So we see that since it's maybe around 1, that there is a decline that happens. And when the bank is large, as these banks are, then a small capital shortfall per dollar of assets ends up being a big S risk. You can see all this in the table. I mean, and we could actually go through it, but.
Thank you for your presentation. So about the Professor Engel's presentation, so you provide some risk management method to us, but recently, so like the investment bank come up with other risk management method, like the machine learning method. So how do you think of those kind of like the new method to the econometrics?
So is that a question whether machine learning is a useful tool for econometrics? Is that?
Yes, and also the accuracy.
Also the what?
The accurate.
Accuracy?
How accurate
Okay.
it is.
Well, I think, financial econometricians are very interested in artificial intelligence, machine learning, all these kinds of new statistical tools. They don't do what we typically want in a model, which is give you something that you think is a structural relationship. What they give you is a way of predicting some outcome. And I think that it's what I always tell my students is that not only do we have the task of modeling this and figuring out what our view of the best answer is, but it has to be something that you can explain to somebody. You have to be able to explain to your boss why this is a serious issue. And if I think that Japan's systemic risk is an important thing, I have to be able to explain that to you in plain English rather than just, this is what the computer said. And when you're using artificial intelligence or some of these new statistical methods, you don't really get much, even though they're powerful tools. So I think we've not really decided whether we think they're accurate enough so that you can just use the results. And I think if you ask most of the people that are using these kinds of methods, sometimes they find things that aren't sensible, and they just throw them away. I mean, nope, start over again. Let's run it again. Let's do it this way. Do it a different way, something like that. And so I think there's a lot of development that is useful for us in financial econometrics, but I think we're going to end up wanting something that's a little bit more structural than just this way of playing chess or solving big problems that can be solved by machine learning.
Thank you.
Stefano, a graduate student here at Keio, and thank you for your presentation. I would like to shift to China a little bit, because we've seen that it's the country with the highest probability of default, of crisis, sorry. So, I mean, we've seen that China is deleveraging for some years, and it still has a very high leverage, especially the financial sector. And on the other hand, the growth is slowing down. So I'm not sure China can deal with two problems without serious structural reforms. So I would like to ask whether do you think that Chinese banks may need serious recapitalization from the state-backed recapitalization, and if so, has China some enough fiscal room to do that? Thank you.
Yeah, well, that's a good question. We'd like to know the answer, wouldn't we? But I'll give you my opinion anyway, which is that the vast amount of Chinese debt is between one state-owned enterprise and another one, whether it's local government or a big corporation or the banking sector. And so, in a sense, we tend to think of it all as riskless and all as sovereign. And I think that's one of the reasons these banks are big and why they make all these loans. The default rates are very low. They have been, for a long time they were zero because there were never any banks that defaulted. If they couldn't pay back a loan, a new loan was issued, and that's true of local governments. Actually, my most recent trip to China, I had a finance officer of a local government say, when we borrow money from the banks, we have to figure out whether we can pay the coupon, but we don't ever expect to pay it back. So they think the loan will be extended forever. So in this kind of environment, there isn't much credit risk, much credit spread between the riskiest institutions and the least risky. Interest rates differ very little. So China is trying, everything I said, and I think everything you said, they are very aware of. They have a lot of smart people in the PBOC and the regulatory agencies trying to solve this problem. And what they're, I think, trying to do is allow a few defaults, but not so many that people get panicked. They would like people to be smarter about where they invest their money, because people invest in these wealth management products that promise high rates of return because they think that they're guaranteed, but they're not really guaranteed. But maybe if you complain to the government, they will actually back them up. And so this sort of thing. So there's a lot of a jawboning campaign, what we call a jawboning campaign, where they're trying to convince people that anything that pays a high rate of interest can't be safe. I don't know whether that's going to be successful or not, and to get people to be smarter about where they invest their money. In fact, they put their money in the stock market, and the stock market goes up and goes down, and when it's coming down, they're trying to pass public policy laws which prevent the market from going down, like you can't sell stock, but I don't know who's buying stock, and you know, it's a complication anyway. So I think there's a decent chance that China will escape a financial crisis, that they will gradually build credit spreads into the loans, and that the banks will be able to reduce their big leverage and their holding of effectively non-performing loans to state-owned enterprises. But I think that would rely on a unified opinion of the Chinese leadership, and it's not that way. That the different parts of the Chinese government have different views as to what the best solution is. And that's why it looks like there is a desire to reduce the leverage and the debt 1 month, and then a month later there's a new spending spree, debt-financed spending spree to build a new road or a new, Silk Road, One Belt, One Road project. And so I don't really know whether China is going to be able to accomplish this or not. But I think there's a lot of risk there.
Okay, I think the time is running up, but taking the advantage of the position of the chair, can I make a final questions? And especially, I would like to ask a question about the pension, because the pension is the one I cannot emphasize the significance of the pension program. So because the Professor Diamond is the global expert of the pension and the social security system, I would like to ask the question. Okay, so both the defined contribution and defined benefit are not Pareto improving policy. There should be the losers and the winners, and especially thinking about the current situation in Japan. I'm not expert of the social security, but most of the pension is the defined benefit. Okay, so then, and also given the situation, there are lots of older people. Okay, then, in a political economy sense, there may not be easy to implement or to introduce the defined contribution system as in kind of the semi-optimal manner. So do you think that lots of older people and the system is already a defined benefit, but that kind of system will not be likely sustainable. So that how we should go on, maybe we should think about taking the right balance, convex combination of the defined benefit and defined contribution for a while, or I would like to know your view about this.
First, let me say I have not looked at the Japanese system, at the projections of the problems. So let me just tell you what's happening in some other places, because it's very common right now that particularly U.S. public employee pensions, but also a lot of private pensions in different places, that they've decided the system isn't viable. Pay-as-you-go systems, people are supposed to understand pay-as-you-go means from time to time you make changes. And the number of countries making changes recently out of the combination of the financial crisis and the increasing awareness of aging is just very large. So the debate that's going on is, if we're going to go from defined benefit to defined contribution, do we do this for all the new employees? And the old ones, we will fulfill a certain large fraction of it. So that's a political issue of the speed with which you make change. The more interesting debate, it seems to me, is the hope that a hybrid, which doesn't mean in some municipalities in the US, a certain amount of your income goes into a defined benefit and the rest goes into a defined contribution, so it's a mix. And that's one way of addressing who's bearing what risks. But the concern is there a way of designing something with a whole bunch of automatic rules which spreads the risk in a better way? And what's happened so far is a number of places have adopted such rules, and I haven't yet seen any good analyses to answer the question, how well will that do, and how well will that do under what sorts of circumstances? It's one thing to say, oh, well, we've got this plan and we ran it through the last 30 years' data and it looks good, rather than saying, well, one of the things we know is the next 30 years' data is going to look different. And how, basically a stress test kind of idea, how would it hold up in different kinds of things? Because the appealing to me part of these approaches is explicit rules, rather than saying, oh, when we get in trouble, we'll negotiate. That, it seems to me, is relying very heavily on the quality of the response. Otherwise, you're relying rather heavily on the quality of the rules, but the rules are at least visible. What kind of quality of response we'll get in 20 years is much harder to predict.
Peter, could I just ask you, you said an interesting thing. Who should bear the risk of pension funds? Is there a good way to think about that?
I think what's important is to recognize there is risk and it doesn't go away. And so you've got to ask, where does the risk fall? So for example, in the US with corporate DB plans and the Pension Benefit Guaranty Corporation, that only guarantees some of it and is itself at the risk of going bankrupt. So a corporation goes bankrupt, the pension holders are in the pack of all the other people with claims on the corporations. So there are risks they don't recognize. With a defined benefit plan and labor mobility, what you're going to get is highly stochastic depending on your career track. Do you stay in the firm? Do you leave the firm? If you stay in the firm, do you get promotions? Do you not get promotions? I don't think it's generally recognized how risky they are, even within that context. Forget about the bankruptcy. And then if it's public employees, then the issue becomes, what kind of risk are taxpayers bearing? And how well does the government financial process deal with a pension risk? What we're seeing in some of the states is they let it grow and grow, and now the states are on the verge of bankruptcy. That has certain shortcomings. I think the complication here is you've got to track the risks down to where they happen. You've got to take a view on the overlapping generation dimension of it. I mean, we all agreed young people can bear more risk than older people. People who are still working and can adjust their income can take more capital market risk than people who are retired and are just living on that. But I think the issue of to what extent are you actually, quote, sharing risk, or are we saying, oh no, we'll bail out the old people and the young people will handle it. You can label it risk sharing, but I'm not sure that's a really good label. So I think this is, to my mind, this is a research agenda. I don't think we've gotten far enough on these things to have answers. You can look at some things and be pretty confident they're a bad idea. The book which we're calling Good Pension Design, I sometimes think we should call Bad Pension Design, because those are the things we can talk about with confidence.
Okay, thank you very much. I think we can learn more from your book. I think we should read your book, I think. Okay, so we would like to have more lessons from you, but we are already 15 minutes behind the schedule, so we would like to close the session here today. So please join me in thanking two giants in economics for intellectually stimulating discussions and the presentation. Thank you very much.